Okay, and we are live and we'll go to borrowing cost. Right. Just waiting a little bit for my internet to be fine. Yes, now let's start. Okay, it's wonderful to meet you all back here. Will not take more than half an hour for borrowing cost. It's the most easiest one. But before that, as a prelude, I want to see what you guys already know about what is borrowing cost. I know, what we are going to discuss is basically whether you should capitalize borrowing cost or not, right? So there would be borrowing cost, there would be interest because there could be some assets which take substantial time to make, correct? So for those assets, we would be borrowing some money for construction, or even if you are kind of putting a new asset, for example, you are buying cold storage, okay, for your business. Cold storage is it's crazy expensive to buy a whole cold storage unit if you're running a dairy and all. So what you do is you borrow money to finance that acquisition. So in such a case, in such a scenario, should we capitalize borrowing cost or not on the base on the asset so that we arrive at the value of asset? So it is all about measurement, initial measurement, whether initial measurement should contain borrowing cost or not. This is the whole gamut of understanding that we have to form after we finalize the standard. So in that, what standard says is yes, you can capitalize. Okay, so you can capitalize for certain assets only, not every asset. So you have to only capitalize borrowing costs in respect to some assets called as qualifying assets. Okay. Now, what is a qualifying asset? I know the transitional provision has something else called as qualifying asset, but qualifying asset is something which takes a substantial time to get ready. To get ready for intended use. And it says mostly 1 year. Okay, this mostly 1 year is not given in the standard. It just says that it takes a substantial time. So now it is up to our, since it's a principle based standards, we have to take some onus as to see, okay, this is substantial as per us, or this is not substantial as per us, is a pure form of judgment. And in a question, if you don't want to kind of capitalize it, you have to say that it does not meet the substantial, it does not feel like a substantial time. Okay, so that argument is very much valid, but a substantial time is something which is purely judgmental. And apart from that, qualifying assets, it takes some time. So let's say that by a machinery you plug and play, that's it. Then that's not substantial time to get ready, correct? So it will take some time to installation and construction. You have to make some few adjustments to it. You have to install it on your customization, etc. So those and all, you can say that it takes substantial time. So only cost arrived for those qualifying assets, you should kind of take borrowing cost. Now, at what time period should I take borrowing cost? Should I capitalize borrowing cost? So there are like three conditions which is given. Okay, as to when to capitalize or what tenure of the interest cost to be capitalized. So what the standard says is there should be three conditions. One, the asset is being ready. Okay, asset is being ready for intended use. Then the borrowing cost is incurred and further costs are ready, costs are incurred. If you satisfy these three conditions, asset is getting ready, it's not finalized yet. Okay, not finalized yet. And the borrowing cost, the interest is being incurred by you. And also the cost relating to the asset is also being incurred. Okay. Then in such a scenario, you can capitalize the borrowing cost. Okay. There are no problems in the standard at all. Only thing is it's a substandard, I would say, because it is just a addition to PP. Okay, so there is no recognition, initial recognition, subsequent recognition, and all. Okay, it's all only initial recognition and initial measurement, whether you have to capitalize it or not. And there is not much presentation gimmicks also. But only thing that is a little bit wild on this is that sometimes what happens is, see, all this is fine if there is only one loan which is taken in respect of the asset. Now, if I cannot say I have four loans, okay, and I've taken for different purposes. These are all personal loans, and I'm using some of this to finance the asset, to construct the asset. Then in such a case, what is the interest cost which I use? We have to use a weighted average formula. That and all we will study. Other than that, there is no much technically, logically very hard in this thing. Only thing is, first you have to verify whether the asset which you are trying to capitalize is a qualifying asset. If it is a qualifying asset, then see if these three conditions are satisfied. If yes, you can capitalize. Okay. To get the amount to be capitalized, you have to lose the weighted average of the. So by weighted average, what I mean is like, let's say that you know you have incurred my connection is unstable. Yeah, it's stable again. So let's say that you have four loans. Okay, you have a loan for 12 million. Okay, you have a loan for 5 million. You have a loan for 3 million. You have a loan for 1 million. Hypothetical scenario. Okay, and total is 12 plus 5, 17, 21. Okay, and this is carrying, let's say, 5% interest, this is carrying 2% interest, this is carrying 7% interest, this is carrying 6% interest, this is carrying okay, this is a total. Okay, so what they say is based on the weighted average of this, like 12 into 5, calculate the weighted average and you find the interest. So let's say that on a weighted average basis, let's say the interest is like, it should be like 4.5%. Then use that interest rate. And let's say that out of this 21 million, I've used the total cost that is used for the asset is, let's say, 5 million. That 5 million into this weighted average cost should be the amount of interest that has to be capitalized. Okay, that is the only other difference thing in, apart from that, there is no major hiccup when it comes to borrowing cost. Okay, so if this is clear to you, let's go ahead and read. Any doubts in, the understanding of borrowing costs? Yes or no? Okay, perfect. So we'll just go read. We'll pick up some things which I may have missed. So there are only two definitions given by the standard. So IAS 23 look at particularly when the related borrowings are applied to the construction of certain assets, then what are usually called self-constructed assets when an entity builds its own inventory or non-current assets over a substantial period of time. Again, the problem is they have given this word called substantial period of time. It's our judgment whether this is a substantial or not. Okay. So there are only two definitions: borrowing cost, interest and other cost incurred by an entity in connection with the borrowing of funds. So basically interest cost. And there is qualifying asset, an asset that necessarily takes a substantial amount of time to get ready for its intended use. Again, substantial period of time not defined. So yeah, they say not that the standard does not define substantial period of time, but an asset normally takes more than a year to be ready to use will usually be a qualifying asset. So they're just giving a usualness. There's nothing concrete. So if it is lesser than 1 year also, based on the business and the other assets, if you say that no, this is also substantial for our business, it's a qualifying asset. Okay. So generally borrowing cost will be capitalized where the impact is material. The standard lists what may be included in borrowing cost. So what is included in borrowing cost? Interest and bank overdrafts. Okay, OD, any interest may it be from OD or long-term borrowings. Okay, OD, short-term or long-term, whatever it is, whatever borrowings cost you have from whatever borrowings it will be there. Finance charge it in respect of leases in accordance with FAFRS 16. So let's say that I have taken an asset on lease to construct this asset. So in that case, the finance element of that is also a borrowing cost. Okay, exchange differences arising from foreign currency borrowings to the extent they are regarded as an adjustment to interest cost. So if I have a borrowing, foreign currency borrowing, to the extent that foreign currency is related to the interest, that is also a borrowing cost. Okay. So depending on the circumstances, many of the following may be qualifying assets because it takes substantially more than 1 year. So inventories, manufacturing plants, power generation facilities, intangible assets, investment properties, there could be a lot of assets which be qualifying assets. Financial assets and inventories that a manufacturer otherwise produced over a short period of time are not qualifying assets. Assets that are ready for intended use or sale when purchased are not qualifying assets. Yeah, if you have an asset, just plug, it will work. No, it's not a qualifying asset at all. I think we are reasonable amount enough to understand that. So capitalization, all eligible borrowing costs must be capitalized. Only borrowing costs that are directly attributable to the acquisition, construction or production of a qualifying asset can be capitalized as a part of cost of that asset. The standard lays out the criteria for determining which borrowing costs are eligible for capitalization. Okay. So which borrowing costs are eligible for capitalization? Those borrowing costs directly attributable to acquisition, construction or production of a qualifying asset must be identified. These are borrowing costs that would have been avoided had the expenditure on qualifying asset had not been made. This is obviously straightforward where funds have been borrowed for financing of one particular asset. Okay. So that what they mean is like if the loan is not needed, if the asset is not required, then that's essential, that's eligible for capitalization. It's a direct loan which is taken for acquisition of this property. Yeah, in difficulties arise, however, we use a range of debt instruments of finance to finance a wide range of assets. So there is no direct relationship between particular borrowings and the specific asset. For example, all borrowings may be made centrally and lend to different parts of group entity. The judgment is therefore required, particularly where there are other complications can arise. Once relevant borrowings are identified which relate to specific asset, the amount of borrowing cost available for capitalization will be actual borrowing cost on these borrowings during a period less any investment income on the temporary investment of these borrowings. It would not be unusual for some or all of the funds to be invested. It's okay. So let's do this question and it would be clear. Okay, let's do this question. On 1st January 20x6, Treeman Co borrowed 1.5 million to finance the production of two assets. Okay, they're making two assets. Okay, and they have borrowed 1.5 million, both of which were expected to take an year to build. So what does that mean? What does that word mean? What should your brain trigger? Co borrowed 1.5 million to finance the production of two assets, both of which were expected to take an year to build. What does that mean? Substantial period. So what are these assets? What assets are these? Then it is a qualifying asset. Okay, like you said, it will take substantial period. So it will be qualifying asset. So you should trigger, okay, IAS 23 will apply. Okay, yes. Uh, Work started during 20x6. Okay, work started during 20x6. The loan facility was drawn down and incurred on 1st January 20x6. So loan was incurred on 1st January 20x6 and was utilized as follows. The remaining funds invested temporarily. So 1.5 million they borrowed. Okay, and the loan rate was 9%. Work started in 2006 and loan facility was drawn and incurred on 1st January. So everything loan interest will start from 1st January 2006 and this is what they have used. So ignore compound interest and the borrowing cost which may be capital for each of the assets. So consequently cost of the asset. So we have to find the cost of each asset on 31st December 20x6. Okay. So let's assuming that 31st December. So basically what is the how do we find out? First I told you we have to see first is cost of the asset. So there is asset A and asset B. Correct? So we are doing what? Initial recognition of these assets. Correct? So first initial recognition is purchase cost and cost to bring it into present location and condition. So what is it? We are doing this as on 31st December. 31st December 20x6. Okay. We can do dollar. Right. Okay. So what is the purchase cost to bring it into present location and condition? We have incurred 250 in 1st January 20x6 and 250 in 1st July. So 1st Jan 20x6, I have incurred 250,000, and 1st June 20x6, I have incurred again 250 and 500. So what should be the total? Total is 1.5 million. So 1.5 million was taken and incurred in such a way. Okay. So let's see, this is a purchase cost. Now let's see, is there any other purchase cost which is given? No, right? So purchase cost to bring it into present location and condition, borrowing cost. Okay. Now we'll look at borrowing cost. What does it say? When should I, three conditions when to capitalize? The asset is being ready for intended use. Yes, during, I think it got ready only in, work started in 20x6 and it will take a year to build. So 1st January 20x6, it will start the work and it will be ending on 31st December 20x6. So first condition is getting ready. Okay. So not finalized it. So 1st January to 30th December, we will capitalize. Okay, whatever is the borrowing cost. Borrowing cost is incurred. Yes, the question says that work started, loan facility was drawn and incurred on first. So borrowing cost is incurred. Costs are incurred on the asset as well. So yeah, the cost has been spent on the asset as well. So should I capitalize? Yes. So what is the a period of capitalization from 1st January 20x6 to 31st December 20x6, I will capitalize. Correct? Now, how much would I capitalize? If you see, for this asset, I have incurred 500 and this asset, I have incurred 1000. Okay, on the of the total 1.5 million, zero point 0.5 million here and 100 million here. So what would be the, so it would be 500 million into, what is the cost of borrowing? Loan rate was 9%. So into 9%, correct? Into what? For the whole year. So total is 45,000 would be the borrowing cost here. And what would be the borrowing cost here? 1,000. I am paying a borrowing cost of 9% for the first year it was getting ready to use. So it would be 90,000. Okay, borrowing cost to be capitalized. Now what they are saying is Freeman's course remaining funds is invested temporarily. So we saw that if there is any temporary gain, that should be reduced from the total cost. Message. Okay, I think it is clear now. Like voice is not doing, but it's pretty clear. What is the borrowing cost to be capitalized? Now we will also be less interest on invested surplus. Right? So that is, see, I got this money on 1st January 20x6, 1.5 million, and I had spent how much? I had spent only 750 million, right? The remaining 750 million was invested in 1st June, 1st June or 1st July? 1st July, my bad. Because they will not give normally for 5 months. So 1st July 20XX is when the remaining was. So interest is, so 750 million was not used, correct? 750 million is reinvested. Okay, 750 million is reinvested at 7% for 6 months. Okay. in this proportion. So 8.75 for this, okay, 750 million, which is invested for, we'll get our income of 7% into 6 by 12 for, because it is only from 1st January to 1st July. And out of the total assets, 1000 divided by 1500. So 17.5. And what is the net capitalized initial cost on 31st December 20x is equal to this plus the borrowing cost minus interest. So it is going to be in this way. Any doubts there? What I did, what is the question asking? Question is asking what is the cost of each asset on 31st December. So I just did cost plus borrowing cost minus whatever is the interest I earned on surplus. Okay. Was my voice breaking? Is there any doubt on the working I did? Okay, fantastic. So this is quite simple. Okay, how you have to treat when there are two assets. When there are two assets, you have to divide the interest cost and the ratio of each asset. So 1.5 million, 500 million used for asset A and 1000 million used for asset B. So the borrowing cost and interest surplus also divided in the same proportion. Okay. Oh, wow. So this is how they are telling us to present the answer. If you see, oh, this is quite nice, right? More than our presentation. So they are saying first they are taking borrowing cost. It is 45,000 and 90,000, and they are reducing investment income. Okay, and they are adding expenditure income, which we did here. So totally it is 536.25 and 1072.5. So this is quite nice. Okay, this is how you have to present in the answer, even though the question uses thousands and all, like they have not used thousands. So this is a very nice way. And let us just also see what are the tools available. There is not much, you can't draw a line and all. There are no borders that is allowed. So how they drew this line is like, I think they would have underlined it. Okay. So that is how they are kind of like, bringing this, but it's very good presentation. But I don't think we have, the commas also, right? And they have used a font of 11. So keep it in mind, we will also use a font of 11. And I can't change the font. It's a uniform font. We can't bring in Lucida Sans typewriter. And there is not much. There are no commas or anything. So whatever commas, I think it's already inbuilt for us to understand. So not much functions, but with this function, one thing you have to see is don't change apart, use 11. Okay, other than that, there is nothing much that we can do here. And in case if you want to bring a line underneath, you have to use underline. Okay. And you can color also. That's pretty good. And you can change the color of the font also. I don't know when we'll use it. This answer above hasn't presented in the spreadsheet. To replicate how you might present your answer in the spreadsheet, it is important that you get familiar with the exam software and the features of it. It's very important. I've been stressing about it. Even I don't know how to use it. That's something that I need your help also. You can do this by accessing the past exams. We'll do that. Okay. So this is how, in June 23 included construction cost in the examiner's report stated most candidates were aware of the principle that the finance cost should be included as a part of cost of the construction. But a number of errors were seen in this calculations. Make sure you practice these as the calculations in the exam can be quite detailed. Okay. So it's all about practice. So here there are like two loans. I told you, you have to find the weighted average and place it. I think that's, see, we can just see 10, they are financing one asset. Okay, 10% bank loan and 9%. There are two loans for one asset. Okay, so how are they doing? They are taking the weighted average. So 120 is the weight of 10% and 80 is the weight of 9.5%. So 10% into 120 by 120 plus 80 plus 9.5 to 80 by 120 plus 80. So weighted average borrowing cost is 9.8. And that 9.8 is used for the amount. So they have seen that only 30 million and 20 million was used. So for that amount, we are using this weighted average method. We need not kind of take on the whole borrowing cost because on the whole loan amount, okay, whatever is used for the construction of asset in the weighted average of cost. So that is, again, commencement, expend. These are the major thing. This is what we kind of talked about. When do you capitalize? The expenditure on the asset is being incurred. Okay, the borrowing costs are being incurred and activities are in progress necessary to prepare the asset for its intended. If these three conditions, these three events must take place, so that you have to incur. You remember one question which we did, whether we said, in on the end of PPE, we will do the capitalization of borrowing costs only when the asset is delivered, not when the asset is placed. When the asset was placed, even though the interest is taken from them, we will not be. That's because it has to take care of these three conditions. Expenditure should be incurred, borrowing cost should be incurred, and activities in progress. Activities also, only when all these three conditions are satisfied, you can start capitalizing. Okay. Now, when do you suspend? Suspend when the active develop any of the three condition is interrupted, then you kind of stop the capitalization. In case there is any strike or temporary delay, suspend the capitalization as required. Now, when do you cessate? When the cessation of capitalization is required, when the asset is ready. Okay, when the asset is ready, you kind of do that. In December 2020, 15-mark requirement on the purchase of machine, which was financed by Poron. I think this is a question that we did after PPE. One big question for 15 marks. If you remember that we did. It's not that hard, but borrowing cost will not come as one question. It would be on top of a PPE question. But one thing you have to remember is, like, you have to first identify qualifying assets. Okay. I'll write it down. In the case of borrowing cost, identify qualifying asset. Then identify if it meets capitalization conditions. Be sure to remember to reduce the short-term interest income we earned from reinvesting the borrowing cost. We took the loan, but I don't need it for the next 6 months, so I invested somewhere and get some small earnings. You should reduce it from the borrowing cost. And of course, if there are too many loans, and one asset, weighted average of that loan, find the weighted average interest